Hi, this is Daniel with Unrivaled Investing. Today I'm going to talk about Alteryx. The stock crashed 30% on Friday. The question is this a buying opportunity or should investors be trying to get out of this? Is this the start of just a bigger crash? I'm personally worried for the long shareholders, and let's dive into this video to sort of size up the company, the opportunity, and the valuation. Here's a disclaimer, you can read it on your own time. So before talking about Alteryx, my value proposition to you with Unrivaled Investing is to try to find potential multi-baggers or companies that can go up hundreds or even thousands of percent over time. I did a video about Livongo, and since then the stock went up about 100%. Novacure is a company that I think has easily a 10x potential. Despegar is a company where I'm penciling out maybe it has 300% upside, but it clearly faces real risks in the near term. So if you're interested in finding potential multi-baggers, hit that subscribe button. And if you're already a subscriber, hit that like button. So why Alteryx? The answer is the company dropped or crashed, the stock crashed nearly 30% on Friday. And so now it's a question of, is this a big buying opportunity? The company has grown a lot over the last few years. I want to understand what's their value proposition, and will the stock price, recover or grow nicely from here? So I believe before you buy anything, even after a 30% drop, you need to size the company's value proposition, their market opportunity, and their valuation. So their existing valuation, because you can have a great company, but if the valuation is too rich, you can still go nowhere for years. So let's dig into each of these components. The first is, does Alteryx have an unrivaled value proposition? So here's a description from their S1. We are a leading provider of self-service data analytics software. Our software platform enables organizations to dramatically improve business outcomes and the productivity of their business analysts. So, I'm taking away from this, reading through this, and you can read it on your own, is that Alteryx is a data platform. They provide data analytics, data visualizations, and they help workflows for companies. They probably have a machine learning element and also some sort of predictive element that, when integrated within companies, makes it easier for the people within the company to make critical decisions for the business. So they keep going. Our subscription-based platform allows organizations to easily prepare, blend, and analyze data from a multitude of sources and more quickly benefit from data-driven decisions. Okay, so pretty much what I just said. The ease of use, speed, and sophistication that our platform provides is enhanced through our intuitive and highly repeatable visual workflows. Okay, this is what I was saying. They're a data analytics company. They create visual workflows for employees to be able to make more intuitive decisions. They probably have a machine learning element as well that will tell you, like, hey, based on these data trends, this is something that you should expect. We aim to make our platform as ubiquitous in the workplace as spreadsheets are today. That's because spreadsheets are using Excel. Microsoft Office solution, is the ubiquitous solution. So the question is, can a data analytics company, surpass Excel in terms of helping companies create new solutions? And that's what they continue to talk about. They go, in the second paragraph, as the volume, velocity, and variety of data continue to expand, the ability to leverage this data for actionable insights has become increasingly foundational to modern business success. So, okay, they're saying data is growing exponentially. It's growing super fast. Companies need to be able to look at the data they're generating and the data they're interacting with to create, successful decisions, to follow the right path. You need to be able to have good insights into that data. And they're saying it's foundational to modern businesses. They're saying this is something that's critical. Okay, this all totally makes sense. They continue, however, traditional data analysis tools and processes are slow, difficult to use, and resource intensive, often requiring multiple steps by information technology or IT employees, data scientists, and other data workers to complete even the most basic analysis. This totally makes sense. They're saying that if you want access to this data, historically you would need a bunch of IT folks, data scientists, and then they're the ones that have access to it. But everyone else in the organization doesn't necessarily have easy access to it. So by hiring or bringing in a software firm like Alteryx, they could help you democratize this data so anyone in the company can see the relevant data and help make the critical decisions. And in the third paragraph, it sort of talks about this. They talk about this is done through visual workflows and intuitive drag and drop interface that can eliminate the need to write code and reduce tedious time-consuming tasks to a few mouse clicks. Okay, this totally makes sense what they're saying. I think I've articulated what their value proposition is. Not clear whether or not it's unrivaled, however. And you can see, if you have good management of your data, what are the types of solutions that Alteryx is addressing? And they talk about sports analytics, automated audit, optimal pricing, customer satisfaction drivers, net promoter analysis, customer targeting, store location analysis, legal risk, predictive maintenance. So these are all things that you can do when you're successfully managing your own data. You can more easily figure out, like, hey, what does the customer want, and what's the net promoter score, and let's dig into why it's this score, or churn analytics. Why did these merchants leave our platform? Things like that. So everything here totally makes sense. A wide range of possibilities, because at the end of the day, you're playing with companies' data. And then looking at this, whoa, this is a list of their customers, 6,700 customers across a diverse set of industries. This is a lot of top tier brands. So this helps me think that Alteryx has a really strong value proposition. I mean, you see Netflix in the media and entertainment space, P&G in the consumer product space, Kraft in the food services space, IKEA, Walgreens in the retail space. These are all major brands. Facebook uses them. So when you see, and they're saying 37% of the global 2,000, so the top 2,000 companies, I presume global companies, use Alteryx. So this is saying they have a really strong value proposition that resonates with companies. And so this makes me lean towards, whoa, they must have a really strong value proposition, or maybe even unrivaled if you're winning all these major logos. But let's keep going. So, if you do a little Googling, looking at Alteryx versus other data analytics companies, you can look at Tableau, which was acquired by Salesforce. Reading this description, and this is a software comparison site, it says Tableau empowers people throughout the organization to easily ask and answer questions of their data in real time, leading to smarter business decisions every day. And you realize that description is pretty similar to the Alteryx one. It has a similar ratings, similar ease of use. I mean, you could read this: the overall experience is good. Tableau provides a solid base of complex data analysis. The dashboards created through Tableau are visually appealing and helps in the quick analysis. Let's read Alteryx review. Despite the complexity of this product, it is a great user interface, and this makes it easier to learn. You're able to get up and running in a very short amount of time. So in both cases, similar amount of stars, similar ease of use. Let's keep looking at this product comparison. So here's Tableau. It's showing how it has ad hoc reports. I mean, you can look at this whole list: predictive analytics, profitability analysis. It's pretty much looks very similar, just from a high level perspective of what you can get. I'm not thinking that Alteryx has an unrivaled value proposition when I see something like this. So then what does Alteryx themselves say about their competitive landscape? And here they're quoting Gartner's Magic Quadrants in their company presentation, and they call out a bunch of different companies. They sort of point out how Alteryx is a leader and a visionary, but there are a bunch of companies that are in that square as well, like Databricks, Tibco Software, MathWorks, a bunch of others, Google as well. So it's kind of worth digging in, like, hey, what can we learn about these other companies? Because maybe they're winning and they're growing faster than Alteryx. Let's keep going. So does Alteryx have an unrivaled value proposition? When you have a list of competitors, a quick way to size up if a company has a UVP or an unrivaled value proposition is their respective growth rates. And just to reiterate, the reason why an unrivaled value proposition is so important is because it implies that you offer something, a good or service, that you can't get elsewhere. And when you have something that you can't get elsewhere, it gives you a right to win in a marketplace. Now, if you have a strong value proposition, which clearly Alteryx has just based on the logos they have, that means you can compete very compete very well and you will grow with the market. But if it's unrivaled, it means you will dominate the market. So there's a subtle difference that has a big impact on your growth rates long term. And longer term, your returns as an investor are driven by the growth of the business. So that's the reason why I want to focus on that unrivaled value proposition. So here it is. I'm trying to size up, our how is Alteryx's competitors growing? And unfortunately, many of these companies are private, so it's tough to get a clean read of how fast they're growing. But once again, you do a little Googling, you see Databricks, which is one of the companies they call out, has increased its annual recurring revenue more than 2.5 times over the past year, and has gone from almost no revenue to a 200 million revenue run rate in less than 4 years. Okay, so this is at the end of 2019. This article. And they're saying this growth is a direct result of rapid customer adoption. So growing, two and a half times in 2019, based on this article, this means Databricks is really crushing it, and they're at a 200 million runway. Whereas, in 2019, Alteryx was growing 65% and was at 400 million. So that's a worthwhile data point in my mind that sort of adds to the case that Alteryx probably doesn't have an unrivaled value proposition, probably has a really strong one, but probably not unrivaled. When I see that sort of data point, that another company, which is half its size, but is growing, at more than double, its rate, if that persists, they easily pass them up within a year or two. So, continuing on this quest, does Alteryx have unrivaled value proposition? Alteryx is not the only analytics or machine learning company helping the largest companies. They called out how Domino, here's Domino Data Lab, how they're trusted by the 20% of the Fortune 100 companies, are using the Domino Model Monitor product, and how they recently completed a $43 million funding round. So clearly, Alteryx has competitors that are getting well financed and that are trusted by major companies as well. So this is not an example of a company that, Peter Thiel likes to look for companies that doesn't have any competition. And that's clearly not the case here. That's just something to keep in mind. When you have something, when you're unrivaled, you're not going to be facing a bunch of people, or if you are, there's something so special about you that it's a tough, it's tough for new competitors to either get funding or to grow quickly. And that's not what I'm seeing here. Here's another, and this is not an apples to apples growth rate, but this is just sort of penciling out like what's probably the industry doing, ballpark. And if you look at Google Cloud, once again, not apples to apples, but trying to get a ballpark for what the analytics industry is doing, because Google did acquire Looker, which is a data analytics company. And you're seeing 43% growth in the second quarter of 2020 for Google. So you're probably seeing somewhere between 20 and 40% growth, revenue growth for the data analytics industry. That's what I would expect. Google Cloud obviously includes a bunch of other things like infrastructure. They talk about G Suite productivity tools, but Google Cloud is growing over 40%, and infrastructure, data, analytics are all key components of it. So it's not apples to apples, but it is growing quickly. So then let's shine the light on Alteryx. And the reason why the stock was down 30% was based on what was weaker than expected second quarter results. And you can see here, while we experienced a slowdown in the second quarter driven by the global impact of COVID-19, we believe that the global opportunity for analytics and automation solutions remains significant, and we believe Alteryx remains well positioned as a leader in the space. Okay, that makes sense, but why is the stock down? So they talk about how revenue only increased 17% in the quarter. And that's a pretty dramatic slowdown from their growth rate of like 65% in 2019. They also talk about their gross profit margin of 90%. That's stellar. This is really strong, operating or unit economics. They also talked about how they grew their number of customers by 27%. That's great. And their dollar-based net expansion rate was 126%. Honestly, I don't like the fact that they use dollar-based net expansion rate of 126%. I think it's a little deceptive here, because net expansion rate implies what's the growth of their underlying customer base. And what this means, because how is it possible to show, dollar-based net expansion of 126%, yet revenue growth of only 17%? And see, that's why I don't like using a metric like that. And it's sort of a tick against management, in my opinion, because this is not really net of churn, I would think, because it's impossible to have your customer base expanding by 20%, 26%, but only posting 17% growth. And that's why, they talk about churn, and I'll get to that in a little bit here, but they also talk about their annualized recurring revenue of 40%. Focusing on annualized recurring revenue, and sort of manipulating the net expansion rate, so so you're not getting a true picture of their underlying growth, does bother me a little bit. Just my own mental preferences were communication styles of management. So why else did the stock get hammered? And I think the outlook for the rest of the year really, hammered them. Where in the third quarter, they're guiding to effectively single-digit growth from 7% to 11%, so single-digit to low teens. And then for the full year, they're only expecting 10 to 11%. So they're not expecting things to pick up significantly the rest of the year. That's a big deal. For a company to go from 65% growth to 10% growth, that means they're taking a real big hit. Let's see what management had to say to sort of justify why this slowdown. So they go, let's turn to COVID's impact on our second quarter expansion activity. As with new business, we saw expansion business sales cycle slow. Conversations with customers indicated that many sought to leverage their existing investments rather than undertake large new projects and consequently postpone or downsize larger initiatives. So when I read that, or I hear that, it makes me think this is not as critical as they would lead you to believe. If you generally, if you step on someone's air hose, you get a heck of a reaction. And that's not sort of what I'm seeing here. This is not a critical item. This is probably a nice to have and not a need to have from a business perspective. This is not like you can turn off the cloud. The cloud data that companies use, like using Azure or GCP, that's a need to have, not a nice to have. This seems like it's a nice to have, just based on how much they slow down quickly. And this is just, nothing here is set in stone, but I'm just sort of reading the tea leaves, the data points that I can get. And that's critical for when you're sizing up an investment, whether or not you want to make it. You're sizing up all these data points. So another comment is turning to retention. As we discussed on our first quarter call, we once again experienced a high customer churn, particularly in smaller organizations and highly impacted verticals and regions, mostly impacted by COVID. Dollar-based churn was predominantly seen in downsized contracts as customers braced themselves for potential economic impacts related to the pandemic and rationalized existing investments. As has been the case in prior quarters, most of the customer churn was driven by organizations with only a single designer seat that had not yet expanded. It is also important to note that customer churn continued to be concentrated in the commercial sector, which we define as less than 100 million in annual revenue, regardless of the vertical. So it seems like what they're saying is that, yes, they're seeing an uptick in churn, which means customers not paying or customers leaving them, which is not really well captured by that 126% net expansion metric that they were touting earlier. But they're saying that the reason why, they're seeing customers leave is it's all these, smaller companies. They're not as significant if you're only doing less than 100 million in sales. I don't know. It's honestly, when I see this, it makes me nervous thinking about it. And I'm not a shareholder. It's just seeing this data point doesn't give me a lot of comfort, confidence. It sort of adds to the view that it's a nice to have, not a need to have. So, asking the question of, do they have an unrivaled value proposition? The answer is not sure. Based on the data that I've seen so far that I'm, calling out in this video, it's really not clear. Sure, it's a sticky business. Sure, customers that are on them, many of them do pay more year after year. They're using more seats are used, but not sure if they're unrivaled. There's a lot of mixed data points. And if anyone, who's watching this has any comments or wants to say why they think Alteryx is unrivaled, believe me, I'd love to read it. So feel free to drop a comment. If you're a long, shareholder and you're like, whoa, this is one of my largest positions and here's why it's unrivaled, I'd love to hear it. But if your thesis is, hey, data is growing, machine learning is growing, it's important to have valuable insights. I agree with you. The question that I'm asking is it unrivaled? And then later I'm going to be asking, but does the valuation already consider a lot of this upside? Then the next question is about the market potential. I think that's honestly a fairly easy question. It's an opportunity clearly worth tens of billions of dollars. I talked about all these things that Alteryx is helping companies solve. So, they pencil up $50 billion. That's obviously a very rough estimate. I think this is, you hit the easy button on this. This is clearly tens of billions of dollar opportunity. It's a, $400 million revenue company. So clearly lots of growth potential. But what about valuation? And, the stock did fall 30% on Friday, or about 30% on Friday. So is this the great buying opportunity where you can make a lot of money on a compounder that not only re-rates, but continues to grow in the future? And so that's where I want to dig in on their valuation. So first, the stock price fell to around 121 bucks a share, and they're penciling out about 71 million shares outstanding. So that gets to about $8.6 billion company. In 2019, they had just shy of 420 million in revenue or sales. And based on their guidance, I'm penciling out somewhere between 10 and 20% growth. Keep in mind that the base and high is still way above their guidance. Their guidance for the year was like 10 to 11. So, my base of 15 is giving them, giving them a little extra credit. So that implies, forward sales of somewhere between 460 million and 500 million for this year, which implies, a price to sales ratio of about 17 to 19 times. This is not cheap territory. And so a lot of folks can say, well, it doesn't matter that it's it's not cheap. This company is going to keep growing in the future. So that's why it gets to this next point of like, well, what do you think it can grow at over the next 5 years? And I'm doing a low scenario of 10, a base of 15 and a high of 25%. This is year after year annualized, and that results in growing, literally doubling, or almost doubling to 740 million in revenue. That's from 2020 to 5+ years out, so 2025, or shy of $1 billion, or 1.5 billion, based on the different scenarios. So going from 400 million in 2019 to maybe $1 billion in 2025, or 1.5 billion on the high side. So somewhere from 1.8 times sales to 4 times sales. So, but in order to sort of think about where the valuation or where the company could be, we not only need to think about the upside growth, but we also need to think about valuation. And we need to understand margins for this company. And thankfully, the company does make it fairly easy to pencil out what they think internally their margins could be. And they show how, and you can see on the right side, they think where they say scale and efficiency, that implies operating margins of 35 to 40%. What I don't like about this is, once again, I don't like some of the ways management presents things, is that this includes share-based compensation, which so that's a real cost that they're not subtracting from this. And so I don't like that, especially when they're showing operating margins of 18% in 2019, when their operating margin was like closer to 8%. You had about 10% stock-based compensation in 2019. So you need to discount whatever they're showing here by somewhere between 5 and 10%. And that's based on what they think they can do, which is probably long-term target, 35 to 40%. So based on these factors, let's keep going with this model. And I think let's slap somewhere between 25 and 35% operating margins, throw a 20% tax rate. And that means 5 years plus out, you're at somewhere between 150 million in earnings, net earnings after taxes on the low side, to around 430 million in earnings on the high side. Which implies, based on the current valuation, based on that future earnings, somewhere between 20 and 58 times. And what's the earnings multiple that you're going to throw on a business like this? And so slap a valuation range of 20 to 30 times earnings. Keep in mind, this is not 20 to 30 times this year. This is 5+ years out. Where we're thinking about this. And that gets you to a valuation of somewhere between $3 billion and $13 billion. So it is admittedly a wide range, but it does show you like I'm trying to do a back of the envelope of what your returns as a shareholder could look like over the next, 5 years. And the reality is there's a good chance you don't go anywhere. Now, I don't have a horse in this race. I don't own Alteryx stock. I'm not trying to, it gives me no joy if it goes down significantly. But I think if you're a shareholder, you should be able to pencil this out in a intelligent way to justify continuing to hold it. Because when I see this, I see more downside than upside. And I personally wouldn't buy it until the downside is pretty much de minimis, and then you have this tremendous upside. That's just personally me, looking at it, and 8.6 billion and saying like, hey, on the downside it's 3 billion. That's sort of tough. And you can see like, hey, what are the assumptions over the next few years? They're only penciling out 10-11% growth this year. Now, sure, maybe it snaps back next year, and maybe over the next 5 years it's closer to 25% a year. But even in that case, and I'm still assuming operating margins that are sort of what they're targeting, because they said they're saying 35-40%, and I'm saying, okay, let's give them 35 because they're not including stock-based comp there. And I'm assuming a 30 times multiple 5 years out. That's a long time to give them a pretty rich multiple. So 50% upside, this doesn't strike me as super compelling. So for those folks that are long or have this as an outsized position in their portfolio, I would just want to think about it. And I'm, as someone that's always looking for bargains, I'm not jumping on this one, even though it did drop 30%. So this is a back of the envelope approach to valuation. A couple things to note is this doesn't factor the cash generation from here. So that could obviously help returns by a little bit because they are profitable. Another aspect is they do have a material cash balance of a couple $100 million. And look, even though I'm saying, upside of 50%, of course it can go way higher than this. It can also go way lower than this scenario. But I'm just trying to pencil out a quick set of potential outcomes. And based on the fact that I'm neither sold on valuation or the value proposition, whether or not it's an unrivaled value proposition, I'm going to pass on this for now. For the long shareholders, I wish you luck. I hope it goes up a lot. But I'm just not sold on it quite yet. I'd love to see more data points that make me think this is truly unrivaled, and make me think they'll continue to have really incredible growth in the years ahead. So if you're interested in what I am buying, for example, this company is growing at 10% this year and is trading at 18 times sales. In contrast, my largest position is a company that trades at like 1 time sales and is growing about 20% this year. So if you're interested in seeing my own personal portfolio, you can go to unrivaledinvesting.com to follow my personal financial journey. Each month I have a post of what I'm buying or selling, and so feel free to check that out if you'd like. And thank you so much for watching. If you enjoy these types of videos or like learning about potential multi-baggers, certainly hit that subscribe button, and thank you, and press that like button.